Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Certainly was a risk-off day in the U.S., and that included Bitcoin. In a moment, we'll take a look at the crypto space with Peter Chung, head of research at Presto Research. But we begin in Hong Kong with Helen, managing director and CIO of Trinity. Happy New Year, Helen. Thank you for joining us. It's always a pleasure. There's a lot to cover. We can talk about the Fed and some of the policies that we're expecting from the incoming Trump administration in a moment. But I'd like to begin with technology because we saw a pretty good pullback today in NVIDIA. I think in New York trading, we were down around 6%. That seemed to be correlated to disappointment over what the market heard yesterday when CEO Jensen Huang gave the keynote address at CES. He failed to mention the company's next generation of chips, Rubin, and that may have been driving a lot of the disappointment. How are you viewing AI right now, broadly speaking?
Look, I think that AI has obviously been really the key momentum driver behind the broader market since pretty much March of 2023 when ChatGPT started to take off. I think a lot of the upward revision in terms of expectations has already happened. And it really depends on which segment of the ecosystem you're operating in to figure out whether there is still further upside. So what we have seen initially is that most of the focus has been on NVIDIA and on the GPU, and then gradually it actually spread out to other parts as well, like any company that has some application that has to do with AI, or even like 1 or 2% of revenues coming from AI starts to become AI plays and see meaningful valuation expansion. And now we're kind of getting to the stage where the expectation is high enough that it's quite easy to miss the high expectations. And therefore, just like before, you had 25% share price move on the back of a slight beat and 2% of revenue AI product. Now the opposite can also happen. And so it's becoming much more selective and much more volatile versus before.
Let's talk a little bit about the macro. Some of the economic news that we had here in the U.S. seemed to trigger concern about stubborn inflation. And with that, the bet that the Fed is not going to be aggressive in cutting rates again. Maybe not until July. So how are you viewing the U.S. inflation story right now?
I think a lot of it is still very much dependent on services. And in terms of the goods front, we've already seen meaningful disinflation. And actually, the broader trend is not so concerning. If you look at the small amount of inflation beat versus expectation, it's really kind of like a very, very minor amount. But I think we do see that last night, for example, the macro data across the board was quite strong. So people think that things are really not slowing down. And I think the other main source of the concern about the inflation is not only what we're seeing today from the strong economy, but also what we might see going forward from both the trade tariffs as well as the loss of labor from the immigration policies that Trump is likely to implement. So that's why people are getting increasingly concerned, not necessarily because of today's data, but because of what might happen policy-wise over the next 3 to 6 months, where there is a significant amount of uncertainty.
Uncertainty, but you're kind of indicating maybe concern about rising inflation longer term, right?
I mean, yeah. I mean, the new normal or the kind of longer term normal is certainly going to be higher versus before because of a lot of the structural things that have changed. So, for example, the deglobalization, right? So those are, or maybe, even though the technology has been helping, maybe the impact of the technology disinflationary trend was seen earlier, like maybe 1.5 decades ago. So obviously, if AI really has a very significant impact in terms of lifting productivity, that's going to be the huge offsetting factor. But at the moment, we're still at the very beginning of that, and it's very difficult to quantify or to figure out how much impact it can have.
So if you can accept the idea that maybe we only get one rate cut this year, the dollar really is going to reflect that and remain very robust against the majors. And I'm sure that for someone in the Asia Pac that has to put money to work, that's going to be increasingly challenging, is it not?
Yeah, it's already been challenging, right? So obviously, beginning of last year, people were expecting like 6 rate cuts last year and maybe 4 more this year. And then now, looking back, the economy has been surprisingly strong in the U.S. And now I think the expectation is a little bit extreme on the other side because of a few things. One is that actually, if you think about it, a lot of the jobs data over the last few 1 or 2 quarters has actually been quite volatile. So it's sure this month we had very, very very strong data, but we can't be assured that the employment data is going to be consistent throughout. And if you do have 1 or 2 months of air pocket again, then I think the yields will sell off and people will start to get more concerned again. The second thing is that a lot of this tariff and immigration policy, and tariff in particular, is not only inflationary, but also potentially going to hurt growth in the U.S., hurt U.S. corporates, and hurt overall activity globally, which will then have indirect impact on the U.S. economy as well. So if that actually happens and U.S. data gets affected, that could also actually increase the expectations regarding more rate cuts versus before. So at the moment, it feels very firm, but usually those are the moments when you can't really see anything going wrong. Those are the moments when you're just like on the cusp of something going wrong. Right. And I think expectations about the U.S. economy and its robustness and the yield outlook are, quite upbeat at the moment.
How are you viewing China right now and opportunities there?
Opportunity is definitely there, but I don't think it's about domestic stimulus necessarily. Domestic stimulus is only enough to get people to feel like things aren't getting incrementally much worse. But all the sentiment and expectation and hopes and confidence rests on really the geopolitical aspect, right? So if you do have very egregious trade policies, it's going to massively hit sentiment, and the markets are not going to perform no matter how much domestic policy stimulus you have. And so I think that's the key thing to watch. I hope that China and the U.S., as well as the U.S. and other major markets that it's dealing with, will have a rapid negotiation at the beginning of this year and try to sort out some of the differences rather than having it, drag out through the rest of the year, which would be actually very negative for global economy and sentiment.
So we've covered a lot of themes, Helen. Can you help me understand what the investment strategy would be going forward here? How does everything translate?
So I think there's two possible outcomes. One is the Goldilocks scenario, which is that the U.S. economy is intact and the geopolitics are not as bad as expected. In that case, everything else catches up to the U.S. in a synchronized global recovery, and you actually have the dollar weaken a little bit and everywhere else that's been totally hammered catch up. That's the best case scenario. In the worst case scenario, the administration gets a little bit too hawkish, drags it out, tariffs, immigration, they end up being negative for the U.S. and elsewhere as well. The U.S. starts to catch down with the rest of the world, then everything actually on the risk assets front actually starts to go down. In the first scenario, what we would look at would be like cyclicals and non-U.S. markets for that catch-up play, because they are basically the ones that are lagging and the ones that would benefit the most from that scenario. And the second scenario, I think, is really about holding cash and maybe treasuries and defensives, all the places where nobody has any exposure in the equity market. I wouldn't even be going that much into like credit just because the credit spread is so narrow at the moment. It has to widen if there is any kind of recession or soft landing fears. So that would be the way that we would look at it. And, hedging as well, because VIX is still low.
So what about things to avoid at all cost? When I was listening to you kind of sketch out the China story, I'm thinking, well, avoid anything that has to do with the Chinese consumer.
The Chinese consumer has definitely been weak, but that Chinese consumer derating or sell-off is actually behind us. It's actually about 6 to 9 months ago. So that was the worst of it. Previously, expectation was always for 20% plus growth, and the stocks were trading at like 20 to 30 times PE, and the positioning was very heavy. I think all of that has already unwound in the last 6 to 12 months. Obviously, whether it rebounds to a significant extent remains to be seen. The low-end consumer is probably the one that the government cares the most about, and so certain consumer staples and other stuff, I think, is the area that we would look at. I think on the luxury and so on and so forth front, most of the global luxury stocks have sold off, but they're not like super distressed per se. And I don't think the Chinese consumer is necessarily going to rebound aggressively on the luxury front, even if the trade tariff concerns go away.
We'll leave it there. Helen, thank you so much for joining us. Helen Ju is Managing Director, also the CIO at NF Trinity, joining us from our studios in Hong Kong here on the Daybreak Asia podcast. Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So Bitcoin's march back above 100,000 didn't last very long. Today, during New York trading, Bitcoin slid about 5%, along with a broader retreat in U.S. risk assets. Let's take a closer look now at the crypto space. We are joined by Peter Chung. He is head of research at Presto Research. Peter joining us from Hong Kong. It's always a pleasure. Happy New Year. Can you help me understand what was going on with the price action in Bitcoin today?
Hi, Happy New Year to you as well. I think what happened last 24 hours is just the typical risk asset behavior of Bitcoin reacting to some very strong macro data that came out in the early hours of US equity market trading. So I think along with the broader risk asset sell-off, I think the Bitcoin also went through some correction. Yeah, I think that's what happened.
When you look at Bitcoin, Peter, the risk asset that is strongly or most strongly correlated with the cryptocurrency, would it be equities? Would it be what's going on in the US dollar? How do you understand the signal that the Bitcoin market is getting from other risk markets?
Yeah, I think the segment of the traditional finance market that has the highest correlation with crypto and Bitcoin is the big techs, especially the Magnificent Sevens. I mean, I think because Bitcoin actually, because it's an emerging asset class that has an element of network effect. So one way of looking at it, Bitcoin is viewed as sort of like a internet startup that has a lot to gain from the adoption of the network by the public. And that's exactly what Bitcoin Network has been going through in the first 15 years of its life.
It's interesting that you mentioned the Magnificent Seven. I think the Bloomberg gauge of the Mag 7 was down about 2.5% today. So clearly a lot of selling pressure. Let's talk a little bit about your expectations on Bitcoin policy or crypto policy more broadly with the new Trump administration. What are your expectations in terms of the regulatory environment?
Yeah, so I think, I mean, there are a few things that will happen. But first and foremost, I think with the Trump in the White House, there are things that can happen relatively quickly through the presidential power. These include things like repealing SAB 121, which is the SEC guidelines that effectively prevents traditional custodian banks from entering into the digital asset custody space. Another thing that could happen, I think, is the end of so-called Operation Choke Point 2.0, which is a name given to the anti-crypto policies undertaken by the Biden administration. I think that can be easily fixed by replacing some of the key members of the federal regulatory agencies. And then the other thing that could happen is on the legislation side in the Congress. Now that we have, the Republican majority Congress and many of the policies that I think the Trump advocated in terms of nurturing the crypto industry requires a legislative process, and these can be undertaken as well. But this will be a little bit more lengthier process, given that it needs to get buy-ins from many lawmakers.
So, Peter, when I hear you describe a lot of the changes that you're expecting here in the U.S., I'm curious about how that may impact markets like Hong Kong or Singapore, where crypto is concerned. Do you have a sense of that?
Yes. So I think many jurisdictions in Asia look to what's happening in the U.S. in terms of crypto policies and regulations, and like to use that as a benchmark. Given that there are, many of the opinion leaders on the crypto industry is actually they reside in the U.S. So I think policymakers in Hong Kong and Singapore, they both view the blockchain as a technology that can enhance their competitive positioning as a financial hubs, and I think they are paying a very close attention to what's going to happen, especially with things like a stablecoin, for instance, which is the initiative that the Hong Kong government in particular is quite interested in.
So I mentioned a moment ago that during New York trading, Bitcoin broke back below 100,000. Do you have a price target this year for where Bitcoin may end up?
We do actually. We published the 2025 crypto market outlook report in December, where we talk about a few things, but one of them is the price predictions for major cryptocurrencies. And Bitcoin, we have a price target of 210,000. I know a lot of people kind of get
Wow.
surprised to hear a big number like that. But remember that Bitcoin has done crazier things in the past. A $210,000 target is about 100% upside from current point on, which is the modest increase compared to the bull cycles of the last 15 years. And we actually have a quantitative kind of approach to this number. So what we did was we didn't just pull the number out of thin air. We estimated what we call the realized value for next year for Bitcoin network, which is a metric that we think captures the adoption of Bitcoin as an asset class by the traditional finance. And that number has been steadily increasing about 5% every month since January of last year, which is when spot Bitcoin ETF was first introduced. So we think the adoption of that asset class through vehicles like ETF will continue into next year. And as long as that happens, I think the realized value target is quite fairly realistic. And we apply a 3.5 times multiple to our realized value estimate to arrive at our fair value estimate for the Bitcoin market cap.
So right now, as I'm speaking to you, I'm looking at a price of just under 97,000, and you are forecasting 210,000 by the end of 2025. Now, how does that map with the overall market cap for Bitcoin? I mean, what do you believe the overall market will be at the end of the year?
Yeah, so that number will be about $4.2 trillion for Bitcoin. So our $210,000 target price is simply by dividing that number with the outstanding Bitcoin units.
So we've talked about a price target of 210,000 in the year ahead for Bitcoin. I'm curious, Peter, as to whether or not you're making other bold predictions for the year ahead.
Yeah, so another prediction that we make in that report is that we think at least one nation state or one S&P 500 company will embrace Bitcoin as a treasury asset. And on the nation state side, it's actually a trend that's been happening for the last at least 4 years. We saw the first of that from El Salvador when they announced the adoption of Bitcoin as the legal tender. The announcement from El Salvador was in 2021. And every year since then, at least one country has been announcing it. You can find the list of those countries in the report. Obviously, last year, U.S. announced the plan to do so, although it still requires approval from the Congress. I think the mere fact that the U.S. Is considering this option, I think is going to trigger a lot of discussions in other countries based on the game theory dynamics.
Peter, we'll leave it there. It's always a pleasure. Thanks so much for joining us. Peter Chung there, head of research at Presto Research, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.